how to sell your house without paying taxes. Hello everyone, and welcome back to another episode at NOVARISE Invest, your channel for financial education. Today, it's an episode about taxes. Did you know that whenever you sell your house, Uncle Sam comes after you and charges you taxes on the gains of that property? If you're looking for ways to not have to pay taxes legally in the sale of your property, you came to the right episode because we're going to cover that today. Let's get started. So first things first, let's level up the playing field. So the way Uncle Sam works in charging taxes, right? Let's say this is your property and you currently want to sell this property for $450,000, right? So sell. And let's say you bought this property for $350,000. So this was your purchase price. And so when you sell it, that means, give or take, you will wind up with a gain of $100,000. So this gain right here, it's called capital gains. And the way it works with Uncle Sam is that depending on the type of taxes that you file, depending on how long have you been residing in this property and the type of property that you had or how long you've had it, the tax rates could range somewhere between 0 to 37%. I don't know about you, but 37% on this number, it's pretty high for me, right? But don't worry. Today, what we're going to do is share with you multiple tips that you can implement legally to prevent yourself from having to pay taxes on that legally, okay? Legally. And the reason why I emphasize legally, it's because this information was taken from the IRS website. And in fact, I'm going to show this to you right now. So that way, you know that this is not something that we made up. It's in fact in the IRS website. And if you want to read further about it, I'm going to leave the link down in the description box below for you to check it out. Okay. So back to the tablet. Let's go over the different ways where you can either prevent paying taxes or just simply postpone having to pay taxes indefinitely. And the way we're going to do this is through two different methods. One, it's if the property that you're planning to sell is used as your primary residence, okay? And you have to have lived there for at least 2 years, okay? And the second way, it's for an investment property, okay? And where you are allowed to use the gains of this property and buy another property that it's of equal or more value than the existing one, okay? So first, let's assume that the property that you're planning to sell is your primary residence. What can you do to prevent having to pay taxes? So according to the IRS, there are two ways in which you can exclude taxes. One, it's if you're filing your taxes as a single person, and the IRS allows you to exclude up to $250,000 in capital gains in your taxes. So in this particular example, we talked about a gain of $100,000. So if your gain at the sale of your property it's $100,000, you're actually covered because the IRS allows you a maximum of $250,000. That's the amount that is going to be exempt from taxes if your capital gains do not exceed that amount. The second way to do this is if you're married and you have to be filing jointly with your spouse, and that will give you a higher exemption, and that is $500,000. So in the case of this example, if you are working on the sale of your primary residence and you got a gain of $100,000, you're still within that window because you're not exceeding $500,000. Okay. So in both scenarios, you won't be paying any taxes. The only exception in which you will be paying taxes is if the capital gains exceeds any of these amounts, depending on how you are filing your taxes. Okay. Now, moving along on to investment properties. So the way it works with investment properties is that you have something that is called a 1031 exchange. And basically, a 1031 exchange, it's a section in the Internal Revenue Service that allows you to take the proceeds from your sale and do a like-kind exchange, meaning with the proceeds of the sales of your property, you're going to use that money and buy real estate of equal or more value. That's the reason why the rich keeps getting richer, because you're forced by the IRS to buy something of equal value, or why not, maybe even bigger. So what is considered like kind? Very simple. Whatever you're selling, in this case, it's real estate, you have to use that money to buy real estate. It doesn't mean you have to buy the exact same house, the exact same structure. No. If you sold a single family home that you use for investment purposes, and now you amass a nice gain and you want to use that to buy a duplex or a fourplex, or why not, maybe even a building if you can afford it, that's how you get to do it. Because independently of whether you're buying a single family home or a duplex or a triplex or a building, that is still considered real estate. So that's the definition of like-kind exchange. Now, I want to pause for a second and ask for your opinion. What do you think about what I'm sharing so far? Let me know down in the comment section below, and your comment will help me get to know you better, so that way I can design a much better episode that can meet your needs in terms of what you're looking to learn. Now, back to the episode. So now, in order to be successful as this 1031 exchange, you have to follow the rules. And one of the most important rules that you have to keep is that you have up to 180 days to complete the transaction. And by complete, we're talking about the property being closed and purchased, or whatever term you want to use, under your name or under your LLC, or whichever way you want to close it. It means it has to be on your possession legally. Okay. So the way things work is as follows. So we're going to use this timeline here. Hopefully it will help you follow things through more accurately. So you have 180 days, you have day 0, you have day 90 over here, day 45, and day 135. All right, so we're going to keep that timeline there. And now we're going to go step by step as to what are the things that you need to keep in mind when doing a 1031 exchange. Well, first, you have to have a property available that you are going to sell, right? So you have to identify that. So second step, you have to identify the property that you want to purchase. And remember, it has to be equal or more value. And then the third step, and this is also kind of a very important one, is that you need to use a 1031 exchange intermediary or facilitator, whichever you want to call it, right? And the reason why is because according to the IRS, whatever proceeds you get from that sale, you cannot touch it, okay? It cannot be under your possession. And what's the definition of under your possession? It cannot be in any of your bank accounts. You cannot physically touch that money. It cannot go through anything that belongs to you, right? And who's an exchange facilitator? So a 1031 exchange facilitator is an intermediary. It's a third party that is going to help you process that transaction. That 1031 exchange facilitator cannot be a family member. It cannot be anyone who has served you in the last 2 years. And an example of that, it could be your realtor, it could be your attorney, or it could be your accountant, because that will be a conflict of interest in the RSI. So you have to use a 1031 exchange facilitator, which happens to be a third party. Now, how do you get a hold of a 1031 exchange facilitator? Very easy. You can ask for referrals, right? Somebody that you know. But my preferred way to do that is just by simply doing a quick Google search. And let me show you how. So we have our friend Google here. And what we're going to do is just to simply type in list of 1031 exchange companies. And we're going to pick it in Orlando because I was actually doing an exercise in Orlando, right? It doesn't have to be in Orlando. You can choose a 1031 exchange provider in the area where your property is located at, okay? So as you scroll down, you will see a recommendation of a list of title companies. So you see 1031 exchange replacement property experts, the closing agent. So this is a title company, but as you can see here, there's a check mark that highlights that they're providing 1031 exchange services. Same thing with American Title Trust that provides 1031 exchange services as well. But if you want to seek for more services, all you got to do is just to click in where it says more businesses, and voila, you have a full list right here on the left side of different providers of 1031 exchanges. All right. And that's how easy it is to use Google, your friend Google, to get the information you want. Now, back to the tablet. Now, the next point that you have to keep in mind is timing. All right. And now we're going to go up here to the timeline. So the way it works with the IRS is that timeline 0 that you see here is when your property is sold, meaning the property that you identify here for sale. So the clock starts ticking when the property is sold. So that's timeline 0. And then from then on, you have up to 45 days right here to recognize or to identify the property that you want to buy. In this case, the property that you want to purchase, right? And then from then on, you have all of this timeline to close on the property. And the IRS is pretty strict about it. So make sure that the property is in your possession, purchased, legally closed, and everything you need to do to have that property with you within 180 days. And then after you're done with the sale, what you're going to do is that you're going to go ahead and report your sale to the IRS, to Uncle Sam, using Form 8824. Okay, and you have to do that. You're required to do this because the IRS is going to find out anyways if you don't report it. Why? Because there are a lot of parties involved in the transaction. There's the title agency, there is the mortgage company, the lender. So anyone who's facilitating your closing is going to have to report that to the IRS anyways. So if you don't end up reporting that sale under your taxes, the picture is not going to be pretty once they find out. So do things right, follow the proper steps for the 1031 exchange, and make sure you report that sale at the end of the year using the 8824 form. Now, I want to take a moment to remind you that if you like this episode, feel free to hit the like button right here below so you can help this episode rank and help others like you looking for information of this kind. And if you happen to know somebody who will find this information useful, feel free to share the love and send this episode their way so you can help change their lives for the better. Back to the episode. Now, I do anticipate a couple of questions coming my way, so I want to address them right now, right? So one of the most common questions I have is, well, it is my money. Do I really have to buy real estate with it, right? So the short answer is no. You can actually use the proceeds of the sale of that real estate and buy a sports cars if you like. But the catch is you will pay taxes on that money because that sports car is not considered like kind. I mean, a car is not the same thing as real estate. And that's how the incentive works. You will get the chance to postpone taxes, and definitely as long as you use that money to continue to buy real estate, to continue to provide housing. But if you use that to buy something else, you are just simply going to go ahead and pay taxes on those gains. All right. Now, the next question that I anticipate is that, can I buy multiple properties, or is it just a one-on-one case? The short answer is that it doesn't have to be a one-on-one case. Yes, I know that the rule says that you will sell one property and you will buy another of equal or higher value, right? But you can also use the proceeds of that sale to buy up to 3 properties. And that is why the 1031 exchange, it's an excellent tool for real estate investors who are looking to grow and expand their portfolio as fast as possible. While I still have you here, make sure you check out this episode on the site that's going to help you complement everything you learned today. Take care. Bye-bye.